Okay, hopefully this is now functioning. I apologize for the short delay. Happy New Year to everybody and welcome. For those of you who have heard me speak before, welcome back to Elm Street. I'm still Freddie. And today we're doing a short session, just a one CPE class, on how tax season impacts mergers and acquisitions of accounting firms. Nikki, did you get the results of the polling question? Okay,
yes, Joel, I do have the results of the polling question here. It looks like 71% of the folks on the call today have just one partner in their firm, and most of the others have 2 to 4, so primarily small firms joining us today.
Okay, well that's important to know, and that's why we asked the initial question. Let me explain to everybody. You know, when you're a $50 million firm, the managing partner is not doing anybody's tax return. And even though they may have a very hefty tax season, the implications for large firms in M&A during tax season are really much less than they are in a smaller firm. Most of us in smaller firms, because we handle a lot more of the chargeable work, a lot of the hand-holding we do, and things like that, makes tax season a much more challenging time of year to address mergers and acquisitions. The implications vary on different things, and we're going to kind of take a quick look at all of them. I never like to make these things an infomercial about us or me, and we don't. But I do feel it's important, and that's what requires us to give a little bit of a background on who the speaker is so that you understand our perspective. I'm the president of Transition Advisors. Over the last 2+ decades. I've been involved in over 1,000 closings of accounting firms, between the ones we manage that we've developed the parties and the voluminous amount where people met on their own and bring us in to help them put the deal together. So what we're going to share with you today isn't because we're the smartest or sharpest tool in the shed. It's because when you've done something hundreds and hundreds and hundreds of times, you make mistakes, you see people make mistakes, and our goal is never to make the same mistake twice. So if you screw up enough in the first 15 years, you get real smart in the next 10. So thankfully you're all hearing us at this point in time. These are just quick pictures of the team. We're pretty much all over the country. I'm very proud of who we are, but enough of the infomercial about us. Let's get into this M&A and tax season implications. I think the first thing I always start with is that any type of someone's considering any type of transaction, especially in our arena, if there's 50 things you need to know, the person in the room is going to think of 35. And we're not going to get you the 50 today. And the reason for that is the uniqueness of each accounting firm. I could show you 3 practices with the same amount of partners, staff, revenue, and even net. And there may be not one other thing in common with them. The uniqueness of each practice and the relationships with the clients and the methodologies and philosophies they follow require the reality to recognize that there's no cookie-cutter way to do these things. But we're going to get you into the deep 40s out of the 50 things and hope that good communication and common sense can get you through the last couple. Let's start with a slide that you're all going to shoot me because I should have probably made it into a couple of slides, so forgive me up front. Well, I'm going to talk a little bit about how we value an accounting firm. Now, because of the nature of our audience, that the majority of you on the phone, the overwhelming majority, are smaller firms, we're going to talk about how we're valuing a practice, selling it externally, not when we're selling it to a partner, and we're selling it, let's say it's under $2 million in revenues. You know, class I teach often for the AICPA as well as our own company on how to value an accounting firm. And you're going to kind of get the Reader's Digest version of that now. Because once we understand how to value an accounting firm, we could talk more specifically about how tax season can impact that. See, when I teach the class on how to value an accounting firm, most of the attendees come with 3 questions. The first question is, what's the multiple? Everybody wants to know what's the multiple because, as you know, most accounting firms are sold on a multiple of gross billings. Some internal sales have been, especially in larger firms, could be a multiple of compensation. But external acquisitions, when I'm selling it not to a partner but to an outside party, it's a multiple of gross billings. So that's the first question everybody asks. The second and third is, what's the multiple? What's the multiple? The point that I'm getting to is everybody focuses so heavily on the multiple. But the reality is the multiple is a small part of the equation, an important part, but nonetheless not where it begins, kind of more where it ends. So there are 5 total main variables we look at when valuing a practice, and we'll see how tax season has an implication in them. The first variable is cash upfront, if any. If any of you on the phone were considering looking to sell your practice over the next 5 years or less and hoping that someone's going to come in and write you a big fat check and shake your hand and say thank you, I'm sorry to be the bearer of bad news, but it is very rare an accounting firm is sold with all cash at closing. What I can tell you is I've been involved in over this 24 years in hundreds and hundreds of them. The average range I see as far as relating to the percentage of cash up front towards the purchase price, day one, has been 0 to 20%. And that range has a lot of other things that impact it. It's not just how deep my wallet or pocketbook is. And this is the first example of where tax season can have a big implication. If I'm acquiring a practice and I'm closing and having it effective February 1st, and I'm acquiring a practice that between February 1st and May 1st bills out 65%, 70% of the revenues that they're going to bill out for the entire year, I'm certainly more inclined to be in a position to come up with more cash up front. So that's where you might see a practice get as much as 20% up front. Because I'm giving you this money up front, I'm going to be in cash flow heaven much, much more rapidly than in other times of year. Conversely, if I'm closing on a practice June 1st and they have billed 65, 70% of their revenues for the year already, I could be carrying that practice barely covering all my expense and everything else. Most of the profit for the year has been sucked out already, in which case I'm highly unlikely to come up with a significant amount of cash up front, if any. Generally speaking, my closings not right on the cusp of tax season, the range of 0 to 20%, most of them will be between 0 and 10%. And I'll have more at 0 than I'll have at 15 or 20%. So it's a very strong impact, because one of the keys in determining how much money up front I'm going to give is how quickly I'm going to credit it back. Another aspect of cash up front is impacted by accounts receivable. If I'm acquiring your practice and you have some pretty slow receivables and you're anticipating that the first dollars that come in, I'm going to pay to you for your receivables, and I'm looking at working 3, 4, 5, 6, 7 months and during that time almost all the money coming in is going to you, and you want a down payment, that's going to be highly improbable. So if you're going to be keeping your accounts receivable and someone, again, is going to be months before they're in positive cash flow, is going to have a lower amount of money up front in most cases. So again, if I'm acquiring a practice this time of year, I'm in a stronger position for money up front. If I'm acquiring a practice in June and you build out a lot and all the money coming in is going back to you, it's going to have a big impact. So cash up front, which is the first variable, not because it's the most important, simply because it's the first one listed on the slide, is very much impacted by the time of year. Second variable has another huge, huge impact, and that is the duration of the retention period. Some people will call it the guarantee period. You know, the 13th Amendment, though, prevents slavery. You can't buy and sell people, so I don't believe it's really a guarantee period, because I can't guarantee you're going to retain the clients. It's a retention period because the retention period is basically saying to you, how long after closing, if I lose some fees or gain some fees from the original clients acquired, will that impact the balance due from the buyer to the seller? So there's typically 3 types of retention periods. One is what some people call an earn-out or a collection deal. So just for the purposes of dialogue, let's say the multiple is 1 1/4 and the payout period's 5 years. Please don't go run around the country telling everybody Joel said you get 1 1/4 for every practice. okay, but we're just using it as an example. If it's a collection deal or an earn-out deal, that means the buyer is going to pay the seller 25% of what they collect from whom they retain of the original clients, typically paid monthly or quarterly over 5 years. 5 times 25%, 125%. Now, that does not mean there's no cash up front. For example, in the closing we had just last week, which happened to have been 25% for 5 years, the seller got $50,000 up front on a $500,000 firm, a small deal that we worked on. They were getting now 25% of the collections for 5 years, less $2,000 a month for the first 25 months that they would have been entitled to credit the money up front. So the cash up front comes off the purchase price when the purchase price is predicated on collections. That's how most of the time it works. Now, obviously, a collection deal sounds extraordinarily buyer-friendly, because what that means in the example I just gave is for the next 5 years, if I lose a client and stop collecting fees, I no longer pay for it. The next type of retention period that you'll see is what we call a limited retention period. An example of that would be the following: a 2-year guarantee, a 1-year guarantee. What that typically means if it's a 2-year guarantee is, hey, for the first 2 years, if there's loss or fees go up from the clients, the seller participates in it. But at the end of the second year, the purchase price locks, and the balance payments are now fixed. So that could be a 1-year period of time, 2 years, 3 years. The third type of retention period is no retention period, where we're saying, okay, when you buy my practice, it's fixed value day one. So let's look at the hundreds of deals we've been involved in, where most of the smaller deals fall in these 3 categories. I will tell you, in 24 years, I've had one closing on an external sale that had no retention period, and the valuation was very low as a result of that. I've had partners sell equity interest to other partners without a retention period, but not an external sale. 80% of the deals we've consulted on or developed have been a collection or an earn-out deal. The other 20% have been these limited guarantee deals, with the highest amount of them a 2-year retention period, and some in the 3-year and less in the 1-year. What's kind of interesting, before we leave the idea of a retention period, and before we tie in how this can impact client retention, is what works best for the buyer and what works best for the seller, as far as who benefits the most from what type of retention period. My partner Terry Putney and I just finished a book that's about to be announced that the AICPA is selling on buying, selling, and merging accounting firms. And in the chapter of valuation, we talked about this. In a survey that we did, here's what was pretty amazing. The worst deal for the seller at the end of the payout period turned out to be the 1-year guarantee deal, the one where they took the least risk. The reason for that is you all didn't realize when you sat for your CPA exam, there was a chemical in the cushions that came up you know-whats and made you all real conservative. I have 99% of my clients will tell me what's wrong with something. 1% will tell me what's right. So when they hear that the seller wants a 1-year retention period, many times they visualize Moses parting the Red Sea and taking all the clients away on day 366. Kind of silly, but the reality of the case. They appropriately perceive a greater risk factor. So what happens? They end up shaking the tree real hard during year 1 because they don't want to lose lease in month 15 and pay for it, that client forever. If they're going to lose a client, they got to lose them in the first 12 months. They also, because they're more aggressive in this, tend to institute changes more quickly, because if someone's going to be unhappy, they want to find it out during the retention period. And they usually offer a lower valuation. So they end up locking the purchase price at the lowest point in time at the end of the first year from a buyer who's the least patient in the transition and offering the lower multiple of the marketplace. What was interesting, and again counterintuitive, is the best deal for the buyer in most cases turned out to be the 2-year retention period, based on the following things, which tells us about tax season a little bit. If I do the work in 2014 and these clients come back in 2015, they're mine. Statistically, the second year is the truest measure of client retention because they've gone through and seen the change. They made a conscious decision that they were comfortable with the change and elected to come back. The likelihood of losing them in years 3, 4, and 5 versus fee increases and special projects is not great. So the buyer ends up locking the purchase price at the time where they've lost most likely what they're going to lose, but stops the seller from participating in the increases thereafter. Now, the exception to that is the 10,000-pound gorilla client. If I have an 800 practice and 2 of my clients' revenues equal 200,000, I'm probably going to want to keep them on a longer retention period and the rest in a shorter one. The best deal for the seller, counterintuitively, was the collection deal. Buyers were willing to pay a much higher premium because they had a lack of risk. Because they didn't have a lock-in, they felt no pressure to institute changes overnight or shake the tree and make loose leaves fall. And what's more likely if I've kept the client in 2 years? As I said before, fee increases, special projects. So the seller ended up getting paid a higher multiple from a practice that continued to grow and participated in that growth, which was far better than any type of interest factor, for example. So the collection deal worked out the best. Now, where retention periods impact tax season is if you have a very strong tax-oriented practice, and we close, for example, February 1st, in many cases, the buyer will be okay with a 15, 16-month retention period because by having it be 2 tax seasons, it's kind of like 2 years. If we're going to close June 1st, we're going to always want at least 2 years because we need to get through that second tax season. So another place where retention can be impacted by because we want to get through those tax seasons. Now, things that have less impact but some impact on tax season, the last 3 parts of valuing is number 3, what's the profitability of the practice? Now, this, unfortunately, is misunderstood all the time. I'm not talking about the seller's profitability. I'm talking about the buyer's. Now, I know that's contrary to the way a CVA, for example, would value a business. They always value the business based on the revenue, net revenue, and profitability of the firm or business you're acquiring. But let me show you why we don't think in those terms. Let's say I had a $300,000 practice. I was operating out of my home. My wife, Kathy, answered the phone, helped me do all the work. We had no other staff, no rent, no overhead. My net was, what, 85%? Then I took an office. Kathy didn't want to come with me, so I hired a secretary. And I decided to play golf on Wednesdays with the dentist. I don't know why they play Wednesday, but they always play Wednesday. Now my net's only 40%. At which time was my practice worth more to you? It's irrelevant. It's what money you make when you acquire it. So if you could acquire my practice with no incremental increases in overhead, no goodwill but a current deduction, another important aspect of profitability, the tax consequences, it's immensely profitable. If I want you to pay me in 4 years, but I want goodwill, and you're deducting it in 15. If I want you to have to keep my location, you got to keep my office manager. Yes, she's making 80 grand a year and 17 weeks paid vacation, but she's been with me for 40 years. It mitigates my profit. So the value here is the value to the successor firm. The fourth variable is the easiest one. It's the duration of the payout period. As I've mentioned, I've never had a deal that was all cash at closing. I only had one that didn't have a retention period. On smaller practices under $1.5 million, $2 million, most of the payout periods we see are 4 to 7 years, with 5 and 6 being the most often utilized. Larger firms tend to be 8 to 10 years because larger firms have less profitability and need longer payouts. Otherwise, they're going to go cash flow negative in a purchase. So once you know the cash up front, if any, how long the retention period is, how profitable the deal is, how long the payout period is, you can address the multiple. The multiple is the effect. Everything else was the cause. So let's use that example of that small firm for $300,000 that all of you on the phone could acquire with no incremental increases in overhead. If I said to you, pay me 17.5% of collections for 10 years with no cash down, structured as a consulting agreement, would you do the deal? That's 1 3/4. I have to tell you, it's been 10 years since I had a 1 3/4 deal. But I'll also tell you, I would do that deal yesterday. Hell, if I raised the fees 8 3/4% in years 1 and 2, I've paid for the entire acquisition. If after 5 years I lost a client, I collected 500%, I still haven't even paid 100%. It's not because it's a 10-year payout. Present value, a lot of people want to apply here, but it doesn't apply. The reason I don't consider it is 2 reasons. Number one, I've always been horrible at present value. I mean, I get the concept, but I never seem to get it done on writing. But that's not the real reason. The real reason is because present value is based on an interest factor. If you buy my $300,000 in revenues, but you increase fees gradually, you increase services, and that 300 becomes 3 1/4, then 350, 400, and you're paying me 17.5% of collections, and I'm participating in that growth, it could far exceed an interest factor. So interest doesn't apply. Now, if the same seller says, I want to be paid out in 5 years, and whatever you do in the second year locks the purchase price, and I want 10% up, but I'll still give you a current deduction, depending on where you are in the country, you're looking at 0.75 to 1 1/4. Same seller says, I want to be paid out in 3 years. Whatever you do in the first year locks the purchase price. I want 20% up front, and I want all capital gain treatment. There's no place in this country I can get that seller one time. That same seller says, I want all cash at closing. I cannot get them 50 cents on the dollar. So what does the multiple mean? Here, I could get 1 3/4 for the same practice in a heartbeat, and I can't get 0.5. So remember the basic rule: the less money up front, the longer the payout and retention periods, the higher the profitability of the structure of the deal, the higher the valuation or multiple will be. The opposite, of course, as well. So the tax implications on cash up front and the retention period are so significant they can have a huge impact on the multiple. You want me to come up with a lot of cash up front after tax season? Highly unlikely. You want me to come up with a lot of a strong multiple and lock it after 1 year, and I only get 1 tax season to see the clients? 1 year doesn't constitute loyalty. It's going to affect the valuation. Another thing it impacts heavily in mergers and acquisitions is when do you start the transition? And this is a really, really important part of the whole equation, and let's spend a few minutes on it. Let's understand the premise that this is going to operate from. The premise is the following. Most of you are small firms. Small firms mean partner loyal clients. See, if I'm a client at Grant Thornton or BDO or any of the real big firms, most likely I am a brand loyal person. I'm going to PwC because I want that brand doing my audit. If I'm going to Mike Farinelli's CPA PC and he's a sole practitioner, I'm going there because of Mike. You see, small firms are partner loyal firms. Let's also think, why do you have your clients? Most of them have no idea if you're competent or incompetent, because if they knew that much to measure your technical skills, why are they paying you to do the work they understand so completely? Of course, unless there's an audit involved. So again, they don't know how good you are. You don't have a national brand. Why do you have your clients? It's because of you. It's a personal loyalty. I have great respect for that. And when handled correctly, it's a very easy thing to transition. The greater the loyalty between a client and the accounting firm, the easier it is to transition them if the transition is done correctly, which we'll speak about before we hang up today. So how does this come back to tax season? Well, let me explain. When I first started doing this in 1990, a lot of my small firms, they went out every month or quarter to their business clients. Heck, a whole bunch of them did the work there, wrote their check, the client signed it before they left. A lot of them did the, like I said, work in the office. Now we're in 2014. If you're not on the cloud, you're going to be. Portals. Most of the work is being mailed in, exchanged from computer to computer, emailed in, staff goes and picks it up. Statistically, according to the AICPA, 87% of the clients of accounting firms are now only seen by the partner once a year in person. You may be speaking and communicating with them more than you ever have, but aren't most of those electronic communications or phone communications? So when I say to someone, I'm 3 years from slowing down, it sounds like an eternity. But what I'm saying to you is it's only 3 visits. And notice I very specifically used the term slowing down. We have to stop thinking in these black and white terms. I'm either selling or I'm working my practice, because most firms don't work that way. They reach a point in time where they like what they do, they want to continue to do it, but they want to work less. So the first question I ask someone is, how many more tax seasons do you want to work full-time? So if someone says to me they want to work 2 more years full-time and then 10 more years part-time, that's only 2 tax seasons. So it's really important when you realize that the one time of year you're physically in front of all your clients in a matter of 16 weeks, typically. Not all of them, but the lion's share of them. This is the single greatest opportunity to demonstrate the continuity of what's going on and make clients comfortable and use tax season to do a tremendous transition. So let's understand that. If I'm closing a deal in June, it doesn't mean you shouldn't, and I'm sending out an announcement letter in June to my client base, I'm going to probably go 10 months before I see a whole bunch of them. If I send out an announcement letter in February, they come in and they see me, the seller's still there, the staff's still there, the fee's the same, I'm going to take away a lot of that fear, and they're going to feel comfortable that instead of it being the loss of me, we now have bigger, better things that we can do for the same fee. Using tax season to conduct a transition is a critical thing for long-term retention. It doesn't mean every deal has to close February 1st. Let's be realistic. Most deals don't do that. But it may surprise you to know that between the deals we consult on and the deals we develop, we're involved with probably approximately 100 deals a year. Do you know in November, December, and January are 3 greatest months of quantity of closings because of the sense of urgency people have to use tax season to conduct their transition. Now, there are other things that impact this, the timing of when to do a transition. You know, if I have a lease ending, I can't tell you how many people make the mistake that they want to slow down and yet they extend a lease. You know, you get a call if you're in my office once a week or a month at the most, or I should say at the least, or a call like the following. Hey, Joel, I'm in Texas. You know, I have a practice that I'm looking to transition over the next couple of years. I'm doing $1 million in revenue, and guess what? I just signed a lease extension. I've got well-appointed, beautiful space under market, goes on, and I say to them, let me ask you a question. How big do you think your successor firm should be? And they say I can hear you, Nikki. So at any rate, they say 2 to 3 million. Well, I said, don't they have an office? If they have an office and you keep an office, you're now telling me I have to retain your space because you extended a lease? So now I'm going to lose half the audience, if not more, than I would have had. And the ones that are willing to speak to me are only willing to speak to me based on reducing the offer they make to me by the cost of that lease. And remember, things are only going to get worse because the baby boomers are aging, right? We're having every year geometrically more and more people closing in on succession. What's always been a seller's marketplace in regional firms, it's already a buyer's marketplace. So it's challenging. So you need to plan in advance. You need to get things done, and the utilization of tax season is an important thing. Now, before we keep going, Nikki, let's get our second polling question done so everybody can get CPE if they have to listen to me.
Great. Thanks, Joel. Is the audio sounding a little better, Joel?
Yeah, yes, it was, although I heard you for a moment, but yes, it was.
Okay. Okay, great. Sorry about the technical issues, everyone. I'm going to go ahead and launch the second polling question here, so please take a moment. This question is, what percentage of your partners are likely to reduce their time commitment to the firm in the next 5 years? You can see the options there, so take a moment to select the one that works for you. And then we've had a couple folks complain about the slides being a little bit too large for the screen. And so what I'm going to do now is resend everyone the link so you can at least download those slides. And we're working with GoToWebinar on that technical issue as well, but at the very least you'll be able to download, and then you'll also have those slides for future reference if you'd like.
Isn't that interesting, Nikki? We've done this how many times, and all of a sudden we're having screen and other things. I guess it's a bad technology day. Our first
I guess
ever,
it must be.
Well, this is our
Thanks,
first
everyone.
ever, and let's hope our last one.
That's exactly right. Okay, it looks like everyone's had time to vote on this poll, so I'll go ahead and close it and share the results. It looks like the most popular answer, greater than 51%. Nearly half of the folks have that many people looking to retire in the next 5 years. The other answers are fairly evenly split, with none being the next most popular, and then the other two about evenly shared after that, Joel.
Well, thank you, because that kind of resembles what the 2012 Succession Survey tells us. It tells us that 67% of firms that have more than one partner have at least one partner within it that are looking to slow down in the next 5 years. And for solo practitioners, 75% of the sole practitioners out there are the founding partners with an average age of 61. Amazing statistics. We're going to see the greatest exodus in our profession in the history at a time where we are starving for young talent. So we're going to lose all this high-end talent, and it's a real quandary. And all these people that are saying to me, Joel, I'm looking for a young person to bring in and groom to be my successors, they better start thinking about another plan, because the big firms are ridiculously overpaying those young CPAs because they have even a bigger succession issue and deeper pockets to do it. So important to start your transition plan in advance. And if we have time at the end of the day today, I'll talk a little bit about a two-stage deal. If not, I encourage you to go to the website, look at the 2 articles about a two-stage deal. It's a deal geared for small firms, especially sole practitioners, who don't want to give up control, don't want to give up their autonomy or their income or their name, but at the same time, they're 5 years along slowing down and recognize they need to do a transition because of the fact that their clients are partner loyal. A real important thing to think about. So now when we come to mergers and acquisitions for tax season, one of the biggest issues is integration. Integration involves a lot of different things. And by the way, I already see I'm getting some questions on the two-stage deal. I'm going to try and save some time to give a Reader's Digest version of it. But one of the big issues of integration today is IT. Let's say I'm using Lacert and you're using CCH. Our pro formas have to be changed. There's a lot involved. I'm on the cloud. I'm paperless. You're not. I'm using 4 screens. You're using 1 screen. So there's a lot of integration issues that take place, and some of that relate to IT. And this can make it challenging. We're going to talk about ways to overcome that in a moment, but let's lay out some of these issues first. Culture is a big issue, obviously. Now, as I always say, if you don't want to eat lunch with someone, you shouldn't be doing a deal with them anyway. So if there's a big cultural issue day one, you chose poorly. But there's another type of culture we don't think enough about, and that's the culture of IT. IT has a culture. I'm going to give you a real simple example. Just 2-3 months ago, a client of mine up in the Boston area, who's a very large client, said to me, you know, Joel, I had told you I was looking for those $5 to $15 million firms to merge in. But I just realized that I need to qualify it a little further. He said, let's say you had 2 firms, same revenues, but one firm was on the cloud, had portals, paperless, multi-screens, metrics just okay. The other firm had really great metrics, but they're way behind in technology. Give me the firm that's where they're supposed to be in technology. And I was shocked by that. And I said to him, thinking that it was a monetary issue, and I'm cheap, so I always think it's monetary. And I said to him, is that because it's usually about $7,500 to $10,000 to train them and get the technology, everything else? He said, absolutely, got nothing to do with it, Joel. What it's about is IT culture. He said, it took me years to go paperless to get to this point, a lot of resistance on partners and staff. Now we all love it, but it was a real challenge to get there. To take that step backwards again, to bring in people who aren't in that position, I can't do. I could take a firm whose metrics are weak and help them strengthen it. I can't get them to throw out the paper if they don't want to. Now keep in mind, everybody, I'm not saying you should throw out the paper or not. What I'm saying to you, there's a culture to it. So that sometimes impacts our ability to integrate during tax season. Sometimes one of the issues that we have to figure out quick is if my senior's getting 80 grand a year and I'm merging into your firm and they're getting 125, eventually my senior's going to find it out. We're going to have a problem. Compensation discrepancies with staff. How clients are serviced. I'm a big handholder. You're not. How are we going to get past that during these things? The administration side. So we all start hearing this list that grows and grows, and we say, what are we, nuts? This is a ridiculous time of year to do that. Part of it, you're 100% right. So what are some of the options you could think about and not worry about these issues? One thing is, if we haven't integrated yet, I suggest you don't. Okay? If it's no-brainer, if we're using the same software, we have similar things, yes, we can integrate right now. But if we're operating with very different things, we can close our deal now, but agree that, hey, we're going to continue to operate as each firm did to get through busy season. So you were using Lacert, I use CCA to do it that way. So we operate two software programs. So we operate differently, under the same roof, but kind of keep things still separate in the way we've all done it before. It's not a big deal to do. And the important thing about doing that is, remember, tax season is the one time of year we see every client in our face. If we can get a deal done and not worry about the integration, the benefits of transition is so important, it overwhelms and supersedes the fact that we don't have to integrate day one. A third option, which is a very popular option once you hit this time of year, is work out everything, close everything, sign the deal, but not have it effective till May 1st. Let me tell you why that could still be a home run. Wouldn't it be better if this February, when a client of mine comes in, I could say, hey, great news, I'm merging with Marcia Miller. And Marcia's fantastic. She couldn't be here today, but before I even send you back the return, I'm going to get their input. We're going to be able, but I want you to know I'm still the principal in charge. We're going to be operating under the same fee structure. I'm still there, but we're going to be putting our offices under one roof. We're going to be able to have a bigger platform of services. So in other words, I use tax season to plant that seed that I'm doing a transaction, that it's going to not hurt you, it's going to help you, and why there's no fear in it. That's a lot easier to do face-to-face than sending out an announcement letter in June. So there's a great advantage to closing the deal now, even if you can't make it effective before tax season and make it effective after. We're going to talk about some other benefits to that in a moment. But also keep in mind that what I would never do, if I have an agreement 99% done, but if the contracts aren't executed, I wouldn't plant a seed at all. I would first of all, you can't say to the client, hey, I'm merging with Marcia Miller, then the deal falls apart because then you look really stupid. And you can't say, hey, I'm thinking about doing a merger without telling them what it means, because then there's a chance they may say to themselves, well, I don't want them picking my successor firm. I'm going to call up my brother-in-law and my sister-in-law and see what accountant they use. It's way too risky to hint to clients about an upcoming transition if you don't have the John Hancock on the contract and able to share that message with specificity of the firm, the location, feature, and the benefits to bring to the table with it. Now, if I'm thinking about merging up or I'm thinking about selling, when I say selling, that doesn't necessarily mean I'm going to sell my practice today and go to Boca Raton. It might mean that I want to work full-time for 3 or 4 more years, then part-time for 7 years. But if I'm 5 years or less from wanting to reduce my time commitment, I need to start a succession plan. So here's some great reasons why I do think it's still a good time of year to get a deal done. Number one, if I'm thinking about merging up or selling, do you want to tell me a better time of year that I would like to have more backup? Who would complain about having more support during the absolute busiest time of year? From a security perspective, what if, as a sole practitioner, I twist my ankle March 1st? One of my key staff people gets sick or something happens and they leave. It's the old story. Nobody gets disabled in November. Everybody gets sick and hurt when? During tax season. It gives me a security blanket. that my successor firm has a vested interest in helping me get through this problem. A lot of sole practitioners looking for a PCA or practice continuation agreements, that if I get hit by the bus, you're going to take over. Or if I'm temporarily disabled, you're going to help me. Well, all of these types of deals, including a two-stage deal, they act as a PCA agreement on steroids because we already have an agreement. We're already sharing files. You know, when you have a practice continuation agreement with someone 10 miles away, unless they have your passwords or your PIN numbers or your records, it's still a search and destroy mission to go in there and rescue you. If we're already doing a deal together and sharing information, it's a lot easier, and I have a vested interest. Excuse me. Again, let's get back to the one time of year we see every client in the base. It really promotes continuity. It really works out beautifully that we're able to start telling everybody the story and lay out the mission. And another thing that we should all keep in mind that hopefully is becoming obvious to everybody is values are coming down. You know, 5 years ago, a typical sale I had was 1.5 times. 15 years ago, it could even been as high as 2 times. Do you know this year, in almost over 100 closings in 2013, I can count on one hand how many deals went for more than 1.25. But I'd need more than my fingers, and I'd probably have to go into my toes to get to the ones that went for less than one time. As supply goes up, demand comes down. So we have an issue here in the marketplace. We have a lot more people seeking succession, which is reducing our value. We're at a time where people can't find talent. So if I'm having enough problems getting my own work done, how interested am I in buying a practice that doesn't come with competent staff? And if your staff was that competent, why couldn't they take over for you? So there's an issue here. So affiliating before tax season enables us to mitigate some of those issues and some of those risks. And even in a two-stage deal, if I'm not retiring for 4 years or 5 years, I can lock in my multiple and value and package today, even though the purchase price may be deferred. If I'm the successor firm, again, why would I be so motivated to go in there and do a deal? Client contact. We're going to see them all. Now's the time. And let's say I want to cross-sell some more services. Let's say I do wealth management, estate and trust work, and you don't, and you merge into my firm. Isn't tax season the great time to plant those seeds? If I'm going to do a deal with you, even if it's not going to be effective till after tax season, don't I want to protect that asset? I want to do this deal. There's no shotgun wedding here. I want to do the deal. Therefore, if I want to do the deal, I should lock the deal up, even if it's not effective till later. I got to protect that asset, that if there's something happens, I'm there to back them up. And I want to use the tax season to conduct a good transition. It offers a certain amount of continuity, that they're not feeling this huge change, as we'll talk about in a moment. And again, as a buyer, what's better than getting involved with a practice right at the height of cash flow? It certainly doesn't stink, you know. A couple of things that you really got to be wary of too. If I'm a firm looking to grow, and I want to be a successor firm, I think people don't realize the messages they send when they say to a seller, hey, you know what, it's tax season, I'm so damn busy, I can't talk to you right now. You know, I don't think people realize what's going on here. If you have a $500,000 practice that I'm interested in acquiring, and I don't have time to speak to you occasionally and say hello occasionally and have a lunch with you occasionally during tax season, even if we're not getting our deal effective by then, if I can't do that, how do I have the capacity to take on your practice later? If I don't have a little bit of time to invest into continuing our dialogue during tax season, am I really in a position to take on another $500,000 or $1 million in billings? And if I am in that position and I'm not giving you the time, then I'm sending you the message that this isn't the most important thing on my desk. It's amazing how so many of us don't get it. You know, I had a managing partner at a firm the other day that we asked for a copy of their compensation, their employee handbook. We wanted to compare certain notes. It's on his computer. He just had to attach it to an email and send it. And he said that, you know, he's really busy. He's getting some year-end planning. It was just between Christmas and New Year's. He'll get it in 2 weeks. Well, my gosh, 2 weeks for you just to attach an email and send it to him? So I asked him, I said, listen, if you had one of your bigger clients, let's say a client that pays you $50,000 a year, called you up and had a simple question, would you tell him you'll get back to him in 2 weeks? The buyer got angry at me. He said, Joe, that's the most unfair thing you've ever said. That's a client. I said, this firm's at $500,000. They have the potential to be the biggest client you have. You have to treat them that way. Very important. Successor firms recognize there is nothing more important on a seller's desk than this deal. If I'm thinking about merging up or planning a succession, this is a way more emotional decision for me than financial. I understand I'm not going to get paid more money not working my practice than working it. We could work out the money. It's the emotional side of it. And if you don't show that this is critical to you, and it's not a priority to you, you're sending a bad message. Also, on these deals, sometimes we're working on a situation where we're going to just continue the dialogue during tax season. We can't get it done. We can't even close it and have it effective later. Well, that's okay. Plant your seeds now. If you're a successor firm or someone looking to sell, plant your seeds. Have a couple meetings. Very few of us are not busy working 100 hours a week January 9th. So many firms, they really don't get crazy busy until much later. When I first started doing this, people were doing their W-2s. How many firms are manually doing a W-2 these days and 1099s? So the reality is we're busy, but can you tell me what's more important of a business matter on our desk? Plant our seeds. And also some firms aren't as impacted in tax season. I've got a firm I'm working with right now, 100% nonprofit. Their tax season was a few months ago. They got nothing but time right now. Also, some firms, they're very business-oriented. Their big deadline's March 15th. Other firms are very personal-oriented. Their big deadline's April 15th. And as a client said to me this morning, his big deadline is September and October 15th because by the time he ever gets all the K-1s and information he needs, everybody's on extension anyway. That tax season's no longer what it used to be as a killer. He goes, conversely, tax season doesn't end now until October 15th, no longer April 15th. So I'm not putting in 7 days a week, but I'm also having to work steadier throughout the year. Right? But time. The reason everybody talks about this being a terrible time of year is time. Well, how much time do you really have to dedicate to move things along in a gentle way, to have a lunch, to do things? It's really very, very serious that people they put things off that they shouldn't. But more important than tax season, more important than anything, always remember if you're looking to do a merger and acquisition, a succession plan, remember my 4 C's. First one's chemistry. If you don't want to eat lunch with someone, don't do a deal with them. The second C is continuity. We already discussed, why do you have your clients? It's because of you. If I'm going to sell my firm or merge with a firm who's going to double the fees, change the hand-holding to a partner's now going to deal with a junior, continuity, if they're going to change the way the ship is sailing and make it in a new direction, are we going to retain clients? We can't put ourselves in a position that someone's going to take it over and make wholesale changes. Do our cultures match up? And the 4th C that people don't nearly think enough about is capacity. If we're a 2-partner firm, and I run into this a lot, let's say we're 2 partners, we're doing $1.2 million. I'm 63 and my partner's 53. I want to slow down in the next few years, work 10 more years, but work less. He doesn't. He wants to work another 10, 15, 20 years, but he doesn't have the capacity to replace me. Well, then we have to merge up, have my younger partner exchange his equity in his firm for the successor firm, and the successor firm combined with my partner helps me create a succession plan. So it's really important that when we're identifying a successor firm, if I'm a sole practitioner or a multi-partner firm, I have to say, who do they have to replace? I'm going to slow down. One of my staff members are going to retire. Do they have the capacity and the skill set, to ultimately replace the people that are leaving? And remember, a good deal is a fair deal. You know, nobody buys a business to lose money. Nobody wants to be Santa Claus when they're a seller. A seller should be paid for their years of sweat equity. It's a major commodity. But buyers aren't going to do deals to go into being cash flow negative. And remember also, it's a package. You can't start by negotiating one piece at a time. I have many times people will call me up and say, we're all over the country, from California to New York to Florida to Chicago, and we get calls all over the country, even in Canada. We just had a closing in Toronto last week, where someone will say, hey, Joel, we worked out everything. All the terms, can you just draft the agreements and help us plan the transition? And the only thing they really worked out was the multiple. I called them back. What's the payout period? What's the tax ramifications? Seller says goodwill, buyer says current deduction. I say, what kind of retention period? How are we handling new clients? How are we handling accounts receivable and work in process? Liability and exposure, leases. It's not brain surgery, but when you negotiate one piece at a time, you never get anything done. Everything impacts the other. Less money up front, longer payout periods, longer retention, higher multiples. You got to put it all down in the paper. And you got to make sure that the team coming together makes sense. And the last thing that I want you all to think about today is the truest measure of success of any deal is client retention. And that's where, again, tax season has a big implication. Because if we use tax season properly, we can take some of that fear and apprehension away and plant the seeds that, look, everything's good. Everything's the same. You see, change is a dirty word. It should be 4 letters. We have to not emphasize that I'm losing something, but gaining someone. So if I'm selling my practice in 3 years, but we're affiliating now, even if we're signing now and not affiliating, moving in together till June, the deal with Nikki, and when someone comes in, I could hand them away. I want you to know that Nikki couldn't be here today, but we're merging together. And you're a doctor. Nikki's an expert in the medical community. So we're pretty excited that we're going to be able to do more for you. But I do want you to know that I'm still going to be in charge. We're going to operate under the same fee. The same staff you're used to dealing with are part of our new combined team of professionals. And we're going to remain geographically sensitively located here in XYZ. Those are the fears of a client. Is the person I trust still there? Is it going to cost me more money? Am I now driving 2 hours to meet my accountant? And for some, staff could be really important. My company's filled with CPAs, but we still have an outside accounting firm that handles our stuff. And the manager at that accounting firm knows more about our day-to-day operations than any of the partners. If they merged up and didn't bring her with them, I'd be mortified. So these are some of the critical things you need to think about. The 4 C's, continuity. That's what a proper transition plan is. And the utilization of tax season to offer continuity, to take away the fear, to give you backup and support is a great thing to do. It doesn't mean you have to close a deal yesterday. Never rush. But don't say to yourself, this is a horrible time of year because we have to work harder. This is a great time of year from a transition perspective, but it's just not always realistic. So maybe we work out a deal where we close now and it's effective later, or maybe we work out a deal where we can't even do either, but at least we could keep the dialogue going. A very important thing to do. Deals kind of have a momentum to them. And once you lose that momentum, it's hard to get it back. So this is our 1 CPE class. It's our last session, not the last CPE I'm doing. I'm doing Head of Value and Accounting Firm for the AICPA in 2 weeks, and we actually have quite a few more CPE that our team is doing. This is our last CPE event until April. We'll be emailing everybody our 2014 schedule soon. But Nikki, we have a last polling question to do and potentially a question or two we may have to address.
Okay, great. Well, we don't have this time, Joel, but we do have our final poll. I'll go ahead and launch that now.
Great.
You'll see the question there, which best describes your firm's goals? So take a moment to answer that. And while you do, I'll just remind everyone that the polling questions are required in order to get your CPE credit, but the other component is the electronic survey. So you'll receive an email from me later this evening, and that'll have a link, and you'll be able to complete that, and then I will send out the CPE certificates to everyone.
Perfect. And by the way, the tone and the voice is perfect now, too.
Oh, good. I'm so glad.
Perfect.
Yes, and in case you didn't hear earlier, because of the technical difficulties, there's also a brief survey that'll pop up once we end the session here in just a minute. If you would take just a moment to complete that, it'll give you an opportunity to request additional articles from us as well as a copy of the slides if you weren't able to download them. But it also gives us some suggestions as we finalize our plans for 2014 webinars. Okay, Joel, it looks like everybody's had a chance to share the last polling question.
Well,
So
as always,
Nikki,
thank you so much for everything. Everybody have a wonderful, healthy new year, a prosperous tax season. There are no bad questions. I will say that many times after we do one of these classes, someone says, geez, I wish I would have asked that, or I wish they would have mentioned something about it. Don't hesitate to give us an email or a call. We're happy to address these things, and I hope everything goes smoothly for everybody, and I hope that you'll find some value in future CPE we teach. Happy and healthy, everyone. Thank you, Nikki.
Thanks, Joel.